Ethereum's price has been flashing dramatic signals across the charts, and traders, investors, and casual crypto watchers all want to know whether ETH is gearing up for a powerful pump or if the market is quietly preparing for a painful dump. Unlike most cryptocurrencies, Ethereum is not just digital money, it's a global, programmable blockchain that powers decentralized finance, NFT marketplaces, and thousands of decentralized applications. Because of this, ETH acts as both a currency and a technology platform, making its market dynamics far more complex than Bitcoin's. Crypto sentiment trackers show fear and greed oscillating daily. Social media buzz swings from euphoria to panic within hours, amplifying price volatility and adding fuel to quick price swings. Understanding these mood shifts is key to spotting whether today's rally is sustainable or purely speculative. In the last few weeks, ETH has tested multiple resistance levels, with sudden spikes followed by sharp pullbacks. Such whiplash movements often precede big breakouts or dramatic corrections, depending on which side gains control. Global economic forces are impossible to ignore. Decisions by the U.S. Federal Reserve on interest rates, inflation reports, and even geopolitical tensions feed directly into crypto markets. If investors expect looser monetary policy, risk assets like ETH can surge, while tightening policy often sparks sell-offs. Meanwhile, on-chain metrics remain strong. Daily active addresses, transaction counts, and decentralized application usage all trend upward, supporting long-term value even when short-term traders panic. Since the merge, Ethereum relies on proof-of-stake validators instead of miners. Millions of ETH are locked for staking, which limits circulating supply and can create upward price pressure. However, large unstaking events could flood the market and create selling pressure, reminding investors that staking cuts both ways. Layer 2 solutions such as Arbitrum, Optimism, and Skyking are also transforming the network by dramatically increasing scalability. Rising adoption of these networks reduces transaction fees and attracts developers, strengthening Ethereum's ecosystem and potentially its price. Institutional money continues to flow toward Ethereum as well. From crypto-focused hedge funds to mainstream asset managers, big players are gaining exposure through exchange-traded products and custodial services, creating steady underlying demand. At the same time, blockchain analytics reveal that large whale wallets have been both accumulating and transferring ETH to exchanges. Heavy inflows to exchanges often precede sell-offs, while accumulation signals long-term confidence, making whale activity a key early warning system. Speculation still plays a powerful role. Meme-fueled rallies and influencer hype can ducker quick pumps that vanish overnight. Smart investors separate social media excitement from genuine growth indicators such as developer activity, enterprise partnerships, and adoption in decentralized finance. Ethereum's developer base remains the largest in crypto, and upcoming Danksharding, full Danksharding, and other scaling solutions lower gas fees and faster transactions. Long-term builders continue their work regardless of daily price swings. Technical analysts highlight key levels around major psychological prices. Breakouts above long-term resistance lines with strong volume can signal the start of a new bull leg, while failure at these levels could mean a double top pattern and potential downside. Regulation remains a wildcard. Positive clarity from the U.S. SEC or European MiCA framework could invite institutional inflows, but sudden restrictive measures changes, staking bans, or security classified trigger rapid declines and spook investors. Looking back, Ethereum has experienced multiple boom and bust cycles. Even during bull markets, 30% to 50% corrections are common. Past behavior suggests that a single pump is rarely the whole story and that volatility is part of Ethereum's DNA. ETH's value is also tied closely to DeFi and NFT activity. When NFT volumes surge or DeFi total value lock grows, demand for ETH increases because users need ETH for gas fees. Conversely, when these sectors cool, so does ETH's transactional demand. Competition adds another layer of complexity. Rivals like Solana, Avalanche, and Cardano constantly vie for market share. If a competitor gains significant traction or offers superior scalability, some capital could rotate out of Ethereum, applying downward pressure on its price. That is why disciplined risk management is essential. Diversification, position sizing, and clear stop-loss strategies protect capital better than any bold prediction, and in crypto, capital preservation is as important as profit. In the near term, traders should watch upcoming economic announcements, staking unlock schedules, and major exchange flows. A break above heat resistance could invite momentum buyers, while failure could bring a fast move back to support zones. Over the longer term, Ethereum's store-pouring decentralized applications, securing billions in assets, and continually upward mirrorings compelling. Whether the next big move is a pump or a dump, those who believe in the technology and plan for volatility will be best positioned to benefit from Ethereum's evolution. Ethereum continues to attract developers who build decentralized applications for everything from gaming to global finance. Each new project that launches on the network adds incremental demand for ETH, since transaction fees must be paid in the native token. This steady development activity creates a strong underlying base of usage, even when traders are focused on short-term price charts and speculation. Another factor influencing Ethereum's market behavior is the steady growth of staking pools. As more users delegate their ETH to staking providers, the effective circulating supply on exchanges shrinks. This can create scarcity and upward price pressure over time. However, if a major staking provider suddenly unlocks or redeems a large amount of ETH, it could lead to a rapid flood of tokens back to exchanges and trigger a swift downturn. Energy efficiency is also part of the conversation. After transitioning to proof of stake, Ethereum dramatically reduced its energy consumption compared with the old proof of work model. This shift has improved its reputation among environmentally conscious investors and institutions. With global attention on sustainability, that reputation could play a role in attracting longer-term capital, even if daily traders remain focused on quick gains. Market psychology often plays a bigger role than fundamentals. During periods of extreme optimism, traders chase breakouts and pile into leverage, which can create exaggerated upward moves. When sentiment flips, that same leverage accelerates declines. Watching funding rates and liquidations on major exchanges gives clues about when optimism or fear might be reaching unsustainable levels. Global adoption of decentralized finance remains another critical driver. Lending protocols, decentralized exchanges, and synthetic asset platforms all rely heavily on Ethereum. When total value locked in DeFi grows, it directly increases the need for ETH as collateral and for paying transaction fees. If DeFi activity weakens, it can reduce transactional demand and remove an important source of price support. Meanwhile, the NFT market, although no longer at the frenzied peaks of 2021, continues to generate meaningful activity on Ethereum. Popular collections, gaming assets, and digital art still require ETH for purchases and gas fees. If NFT interest experiences a new wave of enthusiasm, it can spark additional demand that may influence short-term price movements. Cross-chain interoperability is becoming more important as well. Bridges and multi-chain protocols allow assets to move between Ethereum and other blockchains. While this increases Ethereum's reach, it also exposes the network to security risks. Any significant bridge exploit or hack can create temporary panic and sell pressure on ETH, even if the underlying protocol remains sound. Liquidity in decentralized exchanges is another subtle but important factor. Deep liquidity means large trades can happen without massive price slippage, which helps stabilize markets. Periods of low liquidity, on the other hand, can amplify both pumps and dumps, making short-term moves more violent than fundamentals might justify. Investors should also consider the role of macro correlations. At times, Ethereum trades almost like a high beta tech stock, closely following the Nasdaq or broader risk asset trends. When equity markets are strong, crypto often benefits. When they stumble, Ethereum frequently moves in tandem. Monitoring those correlations helps set expectations for broader market-driven swings. Finally, it's worth remembering that Ethereum's long-term trajectory depends less on any single week's price action and more on sustained innovation and adoption. Whether the next major move is an explosive rally or a deep correction, the combination of developer commitment, institutional interest, and real-world use cases positions Ethereum as a core part of the evolving digital economy. Long-term participants who stay informed and manage risk carefully are most likely to benefit as this technology continues to mature.